we reassemble. We have about 40 or 45 minutes, which is at least a good start. I have to tell you, as I was telling some people upstairs, you know, I've been at this business for about 40 years. That was about the greatest tour de force. I think we all understood it, but I'm hoping that one of you will ask the question that or made the statement that I made to Bill, as Professor Manning was laying all this data out to this, and I said to him, I don't think this is going to end well. I hear about, I know at one of your questions might be, where is this all going to take us, and can we get to a soft landing? What does that all mean? But there are a lot of great questions. I'm going to turn it over to Professor Dickens, and I'm going to sit and I'm just going to take this all in. Thank you.
Well, Barry, that's an excellent question, and why don't we start Catherine off with that?
You know, how long can this go on? And I think if you go back to, I think I might have even sent my article on codependency. I've had two articles that were, I think, written in perhaps 2002 and 2003. And one of them, the title talks about the codependency between China and the United States. And the other one was titled, Breaking Up is Hard to Do. Because that is why we have been able to remain as stable as we have. Now, this is a horrible recession. It is really dramatic what's happened to businesses, to consumers, to people as employees. But if you're in the financial markets, you kind of think everything's fine. It's amazing the length of, you know, people don't even have 12-month hindsight of 2020. But so why, you know, so how could this end? Well, the way it probably is going to end, or the way it's probably going to go along for a lot longer, is the U.S. economy is going to recover. U.S. consumers are going to start to buy products again from abroad. They will be buying products from China, and as a result, our trade deficit will widen. We will be needing to have foreigners buy our U.S. securities. We will be issuing more of them. Why will China and other countries in Asia continue to buy those securities? Well, if they don't, then the exchange value of their currencies will appreciate, making those products that they sell more expensive, which means you wouldn't buy them. Well, if they're very concerned about their producers and their employment, then they will do everything they can in order to keep their currencies from rising, from appreciating. Because they want to be able to sell you goods and services. They want to be able to do that because it represents employment, and it represents economic activity, and it represents political stability, and it represents development. All of those things, you realize, are good things, right? So you can understand why they might continue to follow that set of policies, even though the counterpart is increasing holdings of an asset that may or may not continue to have value, the U.S. Treasury security. They're buying a U.S. Treasury security, they probably think it will continue to have sufficient value. So they're taking a bet on the U.S. securities being valuable, and the reason why they're willing to take that bet is because they really, really want the employment, you know, the jobs, the employment, the political stability, and all the other things that happen as a result of them being able to export. What would happen if they did change their minds? If they took another look at their development strategy? There is an alternative. There's several alternatives. Let's just pick on China for a minute because it's a big country, it's a big number, and it has had an exchange rate policy that by and large has been more managed as opposed to floating. They're not the only ones, however. You could pick on Korea too. What are some of the choices? Well, one choice, which actually has already been underway for about 4 or 5 years, is to, rather than try to sell the products to the United States, let's sell the products to somebody else. How about the Europeans? Because in fact, Europe was growing pretty well, and the euro was, the renminbi euro exchange rate was, basically moves opposite to the dollar renminbi exchange rate, because the euro and the dollar, move opposite to each other. So they basically were able to sell a lot of exports to Europe, and the trade deficit with Europe started to get pretty big. So that's one option. So you're diversifying your export destination. So that means they're not so dependent on the U.S. market, and their requirement to buy U.S. assets is commensurately smaller. But both of those focus on exports. A second option is to, rather than try to sell their product to foreigners, look inward. China's a big country, a lot of people there. An interesting question is why there has not been as much focus on production for the domestic marketplace as you might expect. Consumption as a share of GDP in China has fallen dramatically over the last decade. This is a major surprise because usually you would expect a very rapidly growing economy to return a lot of the benefits of that growth to the domestic consumer. That hasn't happened. Yes, it's true that consumption itself has risen. There's more money in the renminbi in the pocketbook, but as a share of earnings, consumption has fallen. So a question is, well, why is that? And one response is, well, because consumers in China, individuals in China, are saving because of the demographic shift. They have a significant demographic shift going to happen relatively soon, an aging of the population within a 2-decade period. And there's no sufficiently well-developed social safety net or health care. I think ours is bad. Health care, and so people save in the good time, because this is a good time for China. You save now because there's going to be a rainy day in the future, and you don't really have enough kids, and there's not a good health care system that is going to support you, so you better save now. And so if they wanted to change a direction and focus on something other than producing for exports and rather producing for the domestic economy, one important ingredient of that would be to have fiscal expenditures in China on more social dimensions. Now, the last possibility is to just let the exchange rate go, not really produce for the domestic consumers, not really produce for foreigners, or foreigners wouldn't really be able to buy the stuff anymore. The renminbi would appreciate in value, making it more expensive for foreigners to buy Chinese products. And at that point, there would be big adjustments in the Chinese economy. There would be a lot of export industries closing. You would have unemployment. You would have a lot of the real estate that was built up around those export industries collapsing or becoming, see-through buildings. And that, of course, would have big consequences for the economy as a whole, both the financial side and the real side, meaning employment and production. And of course, the consequences in the Chinese economy of that kind of social unrest would be significant. So there are a couple of options. I think the best one, I think the redirection towards the domestic economy that is underpinned by social spending by the government. They have tons of money. They have $3 trillion. They can spend a little bit of it on healthcare and social safety net. that would be my recommendation for a strategy that would be best for China, and along the way, it would unwind this Ponzi scheme that we currently are playing between us and them. Yeah.
My name's Robin Blood. I'm a master's student in the Urban and Regional Policy program here. And I was reading one of your papers about trade imbalances and the relationship between U.S. foreign direct investment and foreign investment in the U.S. and how there's a persistent relationship where industrialized nations get a larger return on their investments, and how that cushions the blow of the imbalance somewhat. And I was trying to conceive of it at, some kind of simple conception, and I was thinking of it like the U.S. is the world's banker with all these products, and they take in that money and then invest it somewhere else and get a higher return. And I was just wondering if you could speak about that, how they get the higher return. Is it institutions? Is it reach around the globe? Or what your thoughts are on that?
Let me ask the question back, or clarify, or expand on it. When we buy a foreign asset, like I could buy a stock and I get a capital gain. I could buy a German bond and I get an interest rate. I could also, if I was a corporation, I could go buy a German company. And if I bought the whole German company, that would be called foreign direct investment. In the way we classify data, ownership and control confers management's control over a foreign asset. Now we could say, the other way around, which is a German company like T-Mobile comes in and buys a U.S. company. I think they bought Sprint. Maybe they didn't buy Sprint. They bought somebody, one of our telecoms companies. And so the German company bought the U.S. company. So that's foreign direct investment into the United States. So there's foreign direct investment, ownership and control happening. U.S. companies buying foreign ones, foreign companies buying U.S. ones. What we observe when we look at the return on those investments, what we find is that when foreigners buy U.S. companies, they make an okay return. They get an okay return. But when U.S. companies buy foreign companies, the return they get, the profitability, so it is the profitability, our management, U.S. management, when it is combined with foreign employees, foreign resources, etc., they're just way more profitable than the other way around when foreign management comes to the United States and tries to work with U.S. workers. This observation and data has been around since the 1950s. And it's always been a puzzle as to why it is true. It has been persistent since the 1950s. And people and researchers have said, well, maybe it's because the United States was kind of the first country to go out in the world and buy up foreign companies, so that we just have a lot more experience working in foreign cultures. It's kind of hard to believe somebody making that argument from the United States, most of whom do not have a passport. But nevertheless, it is true that your U.S. companies have bought foreign companies to a much greater extent, starting much further back. You can remember, in the 60s, certain Schreiber, French anthropologist, this sort of like, the United States taking over the world. Well, think back to it. We were the first, a big wave of U.S. companies buying foreign assets, companies. And so one argument is just that we're older. And so older companies, more established companies return a higher profit than a new foreign investor when they come and buy a U.S. company. It takes a while to figure out how to make a profit on it. So that's kind of a good story, in that our management knows how to manage foreign resources, and that's one possibility. Another possibility is that's not so attractive is that what we observe in the data is actually a figment of tax differentials. And the only reason why it looks like US companies make more money abroad is because between US companies' tax management policies and foreign companies' tax management policies, it's better to have your money abroad than at home. So that's why it looks like we make more money when our management goes abroad. So that certainly is a story as well. The reason why that, although that's that's kind of that bumper sticker type of reason, it's the tax differences, the observation that I said about the U.S. making more money abroad than foreigners coming in here, turns out that that's true for all industrial countries versus developing countries. So if you're French investing in Vietnam, or you're US investing in Vietnam, the French and the US will make more money than the Vietnamese investing in the United States. Let's take another example that's a little bit more realistic. The French investing in Korea, the US investing in Korea, make more money on those Korean investments than the Koreans make when they try to invest in the United States. That's something that we observe across the industrial world. And so if it were taxes, that probably wouldn't be true. A more interesting question, I think, is for how long is it going to be the case that foreigners will want to buy in the US marketplace? For how long will the US buy a whole company abroad? And the reason why that's an important question is the gap in these rates of return is very large. If we look instead at the average return on foreign purchases of stocks, bonds, so it's not an ownership thing, it's just like mutual funds. If we look at what the foreigner earns when they buy the US mutual fund versus what I get when I buy the foreign mutual fund, it's about the same rates of return. And so the only reason why we actually are still making money on our foreign investments total is because of this gap. And so understanding it is really important, but also thinking about the scenarios going forward when we shift away from ownership changes, or cross-border ownership, to just mutual funds and, of course, treasury securities. Yes.
Could we go back to the...
First of all, who are you?
I'm sorry. My name is Joan Murray. Is it closer? My name is Joan Rooney, and I wanted to go back to Barry's question of how is this all going to end? And it seemed as though the three options you discussed all relied upon decisions, particular decisions being made by the Chinese government. Mm-hmm. What are the options for decisions to be made by the U.S. government?
Very good question. The reason why I focused on the China side is because I wanted to make it clear that there were some things that the Chinese could do in their own interest that involved, were not tied up with the renminbi dollar exchange rate. Because that's the renminbi dollar exchange rate, the management of it, and so forth, is really a hot button for the policymakers. And I wanted to make it clear that, that's not what we should be focusing on. It's also not in our control, but we also shouldn't be focusing on it, and we shouldn't be doing things like, let's put tariffs on Chinese goods or something like that. Because if we put tariffs on Chinese goods, we're just going to buy them from Vietnam. So that does bring us, though, to, okay, so what is it in our power to do? And the first thing that's in our power to do is something that's kind of been forced on us by virtue of the financial crisis, and that is at the household level, taking a better look at your long-term finances. For a very long period of time, the household's saving rate has fallen. If we look at the saving rate, which is taking your paycheck and how much of it do you save and how much do you spend, as a nation, our saving rate at the household has gone from maybe 12% in the 1970s. It ultimately was below zero in the peak of the period of time when everybody was saying, I don't have to save because my house is worth, twice what I bought it, and my stock market portfolio is worth 3 times what I bought it. So those perceived wealth made it like people say, I don't have to save anything because I have the perception that I've got a lot of savings in the form of stock market or equity wealth and housing wealth. Well, of course, those were paper wealth for most people anyway, if you didn't get out in time. And so as that perception of, well, how much am I really worth turns into, I thought I was worth this. Well, actually, I'm worth this. People's actual saving has rebounded up into the 5 or 6% range. So some of the adjustment process is happening at the household level, and that is important. We can talk about how, nationally high savings got some problems with it because nobody wants to demand anything. And that has business implications. If nobody's buying anything, nobody's going to build anything, so they're not going to employ anybody. So there are implications, but at the household level, having a better balance between actual savings, generation of wealth in the form of equity and housing, that better balance towards actual savings is an important part of the adjustment process, because if you're saving, then you're not buying imports. However, the other component of the adjustment has to take place at the government side of savings. There are 3 different kinds of savings. There's household savings, there's corporate savings, and there's government savings. You add them all up, you get national savings. Well, of course, 5%, a little bit on the consumer side, well, that's good, but given the fiscal budget deficit that we're in the middle of running, that represents a huge deficit which has to be financed. And so we can either finance it by you buying all those treasury bonds. And if you buy them, then you're certainly not going to, buy anything else. Or we have to kind of split the difference and say, just to have the foreigners buy some of those treasury bonds, we'll buy some of them. But the difficulty of the adjustment process on the external side is because of this very large fiscal budget deficit on the domestic side. So there's only a limited amount of adjustment that can happen at the household and corporate level. There has to be a lot of adjustment at the government, the fiscal level. And that's, in this climate, and with what needs to be done structurally with government spending, that's a very difficult thing to do. I have some ideas, but yeah.
Hello, my name is Evan. I'm an undergraduate economics major here. And my question has to do with the trade deficit. Say tomorrow, Timothy Geithner managed to persuade the Chinese to float the renminbi. My question is, would that entirely eliminate the trade deficit over time, or would it not? Because I think economic theory does predict that it would.
Well, if the only source of the U.S. trade deficit was China, then a change in the single bilateral exchange rate of the dollar to the renminbi would, in fact, under the normal kinds of relationships between exchange rates and prices and demand, in other words, the renminbi becoming more expensive, and that feeding through to make Chinese goods more expensive, so that you don't buy them, and so we would import less from China, indeed you are correct. However, the U.S. trade deficit is significantly with China, but not exclusively with China. And if the renminbi dollar exchange rate moves, that doesn't do anything to affect the other countries from whom we buy things. Now, it might be that if the renminbi appreciates, then the Korean won will appreciate, the Malaysian ringgit will appreciate, the Thai baht will appreciate, and the Vietnamese dong will appreciate, and so a whole set of countries will appreciate, and collectively will buy less from all of those countries. That indeed is true. But even if you take all of those countries, and one of the slides back there told you what the numbers